Thank you, Pam and Mateus. I'm Emily Dyes. I'm an associate at Gowling, and I'm really excited to be here today to talk to you about open banking. So let's start with what is open banking. The Government of Canada defines open banking as a framework where consumers and businesses can authorize third-party financial services providers to access their financial transaction data using secure online channels. Before we dive in to break this down, it's important to note that the term open banking can be kind of confusing. It suggests that personal financial data is simply being made publicly available, and the banks no longer have any control over how it's used or shared, which obviously has privacy consequences and seems risky for the banks. A better term could be consumer-directed banking or customer-directed finance, which are different terms that perhaps better capture what we're talking about here. The idea is that this is a framework that enables a customer, be it a consumer or business, to authorize third-party financial service providers to access their financial transaction data using secure online channels. The customers decide which pieces of information they wish to share and with whom. The chosen third parties then use that information to offer tailored products and services to the customer. The customers can restrict or revoke these sharing permissions at any time. We can think about it like customers owning their data. But what does it really mean to own data? It's not like a dollar where if you own it, no one else can own it. Owning in this context really means having control over how something is used and shared. This comes with two types of permissions. So you can see information sharing is one type of permission, so you can grant people the ability to read your data. And payment initiation, which is basically granting a service provider the ability to actually write to your data, so to change the records that your banks are holding. It's helpful to think in this way about open banking as a utility. So something like electricity. We don't think about how we use electricity in our day-to-day lives, but we think about the applications that run on that utility or that infrastructure. In the same way, open banking allows a whole new range of use cases and applications to run on the infrastructure, but we might not actually know what infrastructure we're using or that it's called open banking. So in order to understand this movement towards open banking, we need to understand what the current processes are. In the existing world, customers do need to share their financial data with service providers, such as financial advisors, creditors, accounting software, maybe something like a refund program for employment expenses. But in order for this to be done efficiently, the most efficient process right now is for customers to actually share their login credentials with providers, and then for providers to use a technology known as screen scraping to pull the information that they need from the web browser or from the mobile application. This has several problems. So the first problem is that requiring customers to share their credentials is fundamentally insecure. It's bad for the banks and it's bad for the service providers. Why is it bad for the banks? Because they can't distinguish between legitimate authorized people accessing the account and unauthorized access. And that puts the banks at potential liability risk if unauthorized access is permitted. It's also bad for the service providers because that means they have to maintain databases of customer credentials, which puts them at a serious risk of a data breach and the corresponding liability. The third reason why the current process doesn't work as well as it could is because screen scraping is not a tool that's essentially tailored to this purpose. If you allow, for example, if you have a service provider that tells you how much money that you spend on the TTC in a given month in order to collect the tax returns that you might be eligible for as a result of those expenses. Right now, if you wanted to share that information, you would need to share your login data and your login credentials, and then you would need to grant access to all your financial information on that account to this application or service provider, which would then need to sort through and figure out what information is relevant. It's possible to design more tailored approaches that actually only give the service provider access to the information that it needs. And that's what the approach of open banking is. Open banking uses something called an API, an application programming interface, that allows authorized third parties to essentially tap into the bank data in a way that is secure. So what's an API? An API is just a set of tools that defines how multiple software programs interact with each other. We can think of it as the glue of the internet. And APIs are not new. They've been around for decades. And you see examples of APIs all the time in your use of the internet. So for example, when you're looking at a web page and it has a box at the bottom that allows you to share to your Twitter page, and you simply click a button, you might have to log into your Twitter account, and then you can share that web content onto your Twitter account without ever having to go onto Twitter's application or twitter.com. What this is doing is it's tapping into Twitter's publicly available APIs that allow Twitter to say, yes, this person is authorized to access this account, and then deliver to the web page the tools that it needs in order to actually write to Twitter's software. Another popular example of an API that you probably see in your day-to-day life is the fact that Uber uses Google Maps APIs in order to run. Rather than designing its own software, it uses information that can be taken from Google software using application programming interfaces. So what are examples of ways in which customers might want to exercise this choice to share their data with financial service providers or to allow service providers to write to their data? We can see on this screen a survey done by Deloitte in 2016 that highlights some of the most popular ways that customers might want to do this. So they might want to use an aggregator, which allows them to view and manage all of their accounts from one simple application. Right now, it's not possible to do this unless you use screen scraping and share your credentials for all of those various accounts that you may have. They might want to use personalized budgeting or accounting tools that track their transaction data and allow them to make insights about how they're spending money. They might want to apply for a loan and share information that can be useful by the creditor in determining their creditworthiness. Or they might want to compare prices of different accounts that they're using and understand where they're spending money on financial services and how they might be more efficient in their how they use their assets. So we're going to look at the global approach to open banking first, and then dive into Canada and what's happening here. The European Union was a really early adopter of open banking. So in 2016, the Payment Services Directive, which is also referred to as PSD2, was introduced. And by 2018, all 28 member states of the EU were required to incorporate it into national law. PSD2 sets out a requirement for banks to share their data with authorized third-party providers, and it establishes a licensing regime for those third-party providers. You can see on the screen there's two types of third-party providers that PSD2 distinguishes between. Account information service providers, so we can think of those as the service providers who need to read data, and payment initiation service providers, and those are the providers that might need to write data. And it sets out, the PSD2 also sets out some of the consumer rights that consumers are entitled to expect when dealing with open banking and with these authorized third-party providers. The UK Competition and Markets Authority followed in 2018 with a ruling that required the 9 biggest UK banks to actually allow access to these third-party providers through an open standard of API. The idea being that in order for open banking to really be adopted efficiently, fintechs need to have some way of understanding what types of APIs they can expect to work with, And similarly, banks need to have standards for using these APIs so that there can be secure, trustworthy sharing of information, and everybody has access to the same types of standards. Importantly, this process was done on an enrollment basis, so it did require all third-party providers to be licensed. And that process basically brings these third-party providers into the world of financial regulation that banks are already operating under, which allows regulators to look at what is their capitalization, what is the history of the people running this, and to obtain disclosure from these parties that really brings them into the regulated financial sphere. Like the UK, Australia was also an early adopter of open banking, and also like the UK, in Australia, it was led by regulation. However, Australia's approach is unique in that it was done through the Consumer Data Right Act, which is a piece of legislation similar to the GDPR in the EU, which you may have heard of, which is really a very broad piece of privacy legislation that grants consumers a host of rights over their data. And one of these rights that was granted through the Consumer Data Rights Act is the right to data portability, meaning that consumers actually have a right to own, as we talked about before, and control how they use and share their data. In the Consumer Data Right Act, it was to be implemented sector by sector, with the financial sector to come first. So the first phase through the financial sector went into effect in July of 2019, and it only required the big banks in Australia to share generic information about prices of their products and things like ATM locations, branch locations through APIs in order to really test the system and see whether this could be done on a secure basis. And then on July 1st, 2020, the full Consumer Data Rights Act in Australia actually went into force. And this requires banks to share consumer data on credit and debit cards and transaction accounts and mortgages with accredited service providers. So like the UK, there's a accreditation process for third-party providers. Continuing with the global overview, in Japan, the Financial Services Authority established an authorization process for third-party providers similar to the UK model. More recently, they also introduced an obligation for banks to publish their open API policies, consistent with the principle that we discussed earlier, that having standards for APIs is really beneficial to the secure and efficient adoption of open banking. So this really, the approach in Japan is really to create the infrastructure to allow banks to eventually adopt open banking, but not requiring them to actually grant their customers data access rights at this time, or data portability rights. And in the US, in contrast to each of the jurisdictions we just discussed, there's actually no regulation or mandatory program requiring banks to implement any type of open banking. However, there's also nothing prohibiting it, provided that banks also, continue to abide by existing regulation, including consumer protection laws, fair banking regulations, and privacy laws. So in the absence of a mandatory program, there has been a market-led program. So banks are taking a variety of different approaches driven by consumer demand to grant their customers the ability to share their financial data. The primary issue with the market-led approach is really the absence of standards. So without the UK context where banks are required to take the time to really establish APIs that can be used securely and are standardized, there's still widespread use of screen scraping and it can be very inefficient for banks and third-party providers to decide to deal with each other, requiring negotiation really between those parties as opposed to simply tapping into this existing infrastructure. And there are industry-led groups right now that are designed to address that very point of really getting financial institutions together to decide to collaborate on the development of open standards. Okay, so now we turn to Canada. In Canada, there has been significant interest since 2017 in open banking. So in August of 2017, the Department of Finance announced its intention to examine open banking. And then in the federal budget in 2018, it reiterated the Department of Finance's intention and proposed a formal review process. In September 2018, this was initiated through the formation of a Senate advisory committee with the first 4 members appointed. And the hearings in the Senate proceeded through February 2019 to April 2019. In June of 2019, the Senate Committee on Banking, Trade, and Commerce released its first report as a result of those hearings, titled Open Banking, What It Means for You. And the Senate report recommended urgent action on open banking. It made 10 recommendations to be implemented in the long term. And 3 of those recommendations for the short term are to designate the Financial Consumer Agency of Canada as the oversight body, to begin developing a regulatory framework, and to provide immediate funding to investigate the risks of open banking. Over the long term, the goals seem to be reform to PIPEDA, which is Canada's federal privacy legislation, the creation of a registry for third-party providers, and the introduction of relevant legislative changes to Canada's financial regulatory laws. We haven't seen any of those changes yet, or any of the changes to the ancillary legislation, but that's all laid out in the report. And following consultation with stakeholders on that report, in January of 2020, the advisory committee released a second report entitled Consumer-Directed Finance, the Future of Financial Services. And the key takeaways from that report are that open banking should be designed for inclusion. So Canada's really looking at how are people potentially negatively affected by open banking, and how can we design this from the beginning to have those inclusion of those people in mind. It also talked about the requirement to establish cybersecurity best practices, potentially involving amendments to Canada's privacy legislation. And it also stated that under open banking, liability for data breaches should rest with the party at fault, not with simply the bank. So in current systems, liability for data breaches really does rest with the bank in many situations, because banks cannot distinguish between authorized and unauthorized access to customer accounts. But in this new model, where customers have the ability to actively share their data to permissioned parties, the party that is responsible for data losses is the party who the liability should fall on, and who should be responsible for complying with standards that are designed to protect that data. Okay, so what is the consequence on the business of banking? Primarily, open banking is designed to create competition in financial services industries, because it allows customers to share and own their data. So it allows new market players to offer services that weren't possible before. But it also expands the range of financial services that banks can offer and that customers will come to expect, by providing new opportunities for banks to serve their customers. Ultimately, open banking means more financial services. And it also means that there are opportunities for banks to collaborate with fintechs in a way that is secure and minimizes liability for the bank. In order for banks to really take advantage of open banking, they need to be aware of the range of of financial services that customers will be able to take advantage of using open banking, and they need to be flexible in collaborating with fintechs who will have new resources available to them as well. The current model of banking really involves banks managing both the interface and all the products and services that are offered to customers through that interface. We discussed before about parties that have third-party service providers who will have read permissions on multiple different accounts. This really sort of undermines the concept of banks serving as a primary interface because fintechs have significantly more flexibility in designing interfaces that work for customers, and that's really their expertise. So in the future, Deloitte considers a number of different business models that banks might choose to adopt. They may continue to be a full service provider, which is what banks are doing now. This is really the status quo, where they offer the interface and they offer all their proprietary products through that interface. They may operate more like a utility, as we discussed before, where they provide the infrastructure, but they're not a primary provider of either interfaces or products and services. They may primarily be a provider, so they may offer their products and services into the marketplace of financial services to basically compete with all the other products and services that are out there. Or they may primarily be an interface, which, as we discussed, banks may not have a competitive advantage in that compared to fintechs who are really experts in designing interfaces. And really the most likely conclusion is that banks will offer sort of a menu of 1 to 4 and be involved in all of these different ways. In Canada, compared to the other jurisdictions we discussed, research shows that customers really do strongly trust their banks. So there's multiple opportunities for banks to take advantage of open banking and to really immerse themselves in these new financial services marketplaces. What are some legal issues that we expect to deal with as a result of open banking? So the first is this regulation and licensing of third-party providers. We expect that there will be significant regulation bringing these providers into the existing financial regulatory regime that banks, credit unions, loan and trust companies are currently required to comply with. We will be interested to see if the scope of the regulation that Canada puts forward, whether it's more towards the UK approach of really being narrowly targeted at the financial sector, or whether it introduces broader open data rights for consumers. We'll be interested to see how privacy laws change as a consequence of this. And we'll also be interested to see how consumer protection laws and laws relating to liability develop, and what types of risks third-party providers are expected to take on as compared to the banks themselves. So thank you very much for participating. And if you have any questions, please paste them into the chat and join me at my session at 2:30 for question and answer. Thanks very much. Please make your way back to the main stage.